In this trading strategies to set or forget series, guys, we're going to look at an intraday strategy, which is a mean reversion day trade, one that you can set up before you go out in the morning to work if you're working, and one that you can potentially capitalize on those stretch markets that might reverse without having to be in front of the screen. Stick around for this one. Hey guys, warm welcome to you. Right, so this one is kind of built around a trading strategy that I like to use intraday when I'm at the screens, but it's something that you can perhaps use with a set and forget type strategy. Now, set and forget is for those of you who are busy doing other bits and pieces, running a business, going to work, other commitments. You want to still be involved and you want to have a specific strategy you're looking for, but you can't be there in front of the screens all the time. So this is the sort of thing that you might do with small size. This is the sort of thing that you might do just to get you into a trade and be aware of a trade. And so these are never something that you go out there and just put all your risk on, because listen guys, the real sweet spot comes when you're able to execute and adjust for the conditions that change intraday. And of course, if you're not there, it's not always going to be the very best for you, but it's a good compromise. If you can't be there, it's a good compromise and something you can put in. You know that it's working for you. You know that you'll be taken into the trade, you'll be taken out if it doesn't work, etc., etc. So it's a nice position to be in. You feel like you're doing something and learning something, even if you can't be in front of the screen all the time. Okay, so this is the mean reversion day trade. So what we're going to do is we're going to look at any market. Look at the ATR. So a 10-period ATR is a great way of doing it. So the last 10 days, the average range, the last 10 days. So let's say, for this argument's sake, that is 100 pips. And we're going to use a Forex pair for this, but it could be a stock, could be a commodity, could be a currency, could be an index, whatever. So let's say we look at the ATR. Now we want to do technical analysis on the chart, which is why it's quite a good one, because it's not just purely clinical. You've got to have some kind of skill and element of intuition with this. So you start to do technical analysis on your charts on your favorite markets, and what you're trying to do is you're trying to mark off the key support and resistance levels. So I've got one here. There's a key support level here. There's a key resistance level there. If you're not familiar about how to do this, go and check out some other videos that talk about how to draw support and resistance levels. But most of you understand the concept of support and resistance. So we've got our support and resistance levels, and what we're doing is we are saying, hey, if the support or resistance level falls within 1 ATR from the open or expected open. Now, let's understand there's gaps and stuff you might not be in the morning, so adjust it to suit. But imagine that we're going to open around here. 1 ATR would be here. Let's say that would be 100 pips because our ATR is 100. So what would happen is that would be, if we drove straight up there, that would be 1 ATR. In reality, we end up driving up a little bit and then driving back, and the ATR kind of shuffles the range, does this, doesn't it? So what we're trying to do is we're trying to say, okay, we've done our technical analysis. If a support and resistance level falls within 1 ATR, so we kind of draw that with our dotted lines on if we need to, which would be 100 pips from the expected open, then we can initiate an order, or we can put an order to be filled. So in this example, we've got support here, but it's below 1 ATR. So we didn't want to take that because it's not within the expected range of the day. The expected range of the day is 100 pips. This is outside of it, so we're not looking to place an order there, because generally speaking, or the thesis we're using anyway, is that if we start to stretch outside of it, it could be a trend-based day, and I don't really want to be buying at support. That's the idea. Whether you want to adjust that, up to you. So we do have a resistance level here that falls within ATR. Let's say that's 70 pips up. Great. So the theory is that the market will stretch up. It's close to being a 1 ATR. It might struggle there, or maybe just get to it and roll back down again, and we're going to close it. That's the theory of the trade, right? The theory of the trade is market's going to stay within its expected range, and the added pressure of the resistance level is going to stop the market in its tracks, or at least slow it down enough for us to use that as a point to get into the trade and for it to come back lower. So if it falls within the ATR range, then we're going to place a buy limit or a sell limit. Right, so let's focus on this one first. That will be a sell limit, so we're looking to go short. So we're now going to put a sell limit, and we're going to put it a little bit above. So in this case, with this order of magnitude, 70, 100, we're probably going to put it about 75, so 5 pips above, so about there, or maybe 80, something like that, or maybe 77, something so that you're not actually sitting below it, you're not sitting on it, you're just sitting for the spike above. You're not always going to get filled in this, it's not always going to work, of course not. It's just an idea for you to, maybe use as a seed to move from. So there's your sell limit. and you're going to have an if done order, a stop order, say, you know, half of the ATR or a quarter of the ATR. This is up to you to play around with. I don't want to kind of force too much of a risk management onto you, because ultimately it's very personal, but something like that. Now, depending on where the resistance is as well, you might want to put it above the ATR. You might want to play around with it, but the point is you've got to make sure that you attach the stop. So what happened is the market comes up, it hits that level, you're now short, it immediately executes the stop and puts the stop live. So if the market keeps on going, which it will do from time to time, you're not always going to get winners. If it keeps on going, then you're going to get stopped out. So you've got protection. If the market's ripping up and it just runs through, fills you, you get out, you're going to get stopped, you're going to lose money. However, the theory of this is that you're going to get filled and it's going to come back, and on a normal day, if we're talking about a normal kind of every Sunday day, it will probably close around the VWAP or the midpoint or something like that. And so the idea is you then come back at whatever time you can, before the close preferably. If it's a stock, you've got to make sure you're before the close, obviously, to make sure you can get out of the position, or you can ring, or you make sure you can get onto your phone before the close, or if it's a currency pair, it's going to be the evening. If you're in Europe and it's US, it's going to be at 9 o'clock. So whatever the point is, you're going to close it at the close. So this gets you into the position when you're not at the screen, and enables you to get into a mean reversion type trade when you're not at the screen. It protects you with that stop that goes in at the same time, and then your exit is going to be at the close. So you're expecting this market to stretch up. You're saying, hey, I think that it will stretch up or down, and I think that because we've got this key level of resistance there, that will stall it. I'll take a short above it. It'll then cascade back lower, and we'll end up closing at a midpoint or a VWAP, or maybe back at the open, and I'll take my profits. If that doesn't happen, then I've got my risk capped by putting my stop above it, and vice versa is the long side. So it's got a bit of work, with this one. You've got to kind of do some technical analysis on your charts. You've got to do a bit of research. You've got to do a bit of charting. So it's a little bit more interesting than just setting stuff. So you're a bit more engaged, and you can pick the ones that perhaps are right, look better for you than not. So you've got a little bit more involvement in it. And then you can just set it and say, right, and then maybe set an alert and say, oh, I'm into the trade now, fine. And then make sure that you're out of the trade before the close, depending on when the close is or what instrument you're trading. And obviously, if you're doing a technical analysis and it's away outside of the ATR, then that's not very useful for that day. But of course, if we end up closing down here, for example, the next day, all of a sudden that then might come into play, and you might look to trade that one. All right, guys, so that's the set and forget series, the mean reversion day trade. Take care, keep risk management, whatever you do, and make sure that stop goes in at the same time. Bye-bye.